the discussion I would have with sort of a new, technology client about kind of the legal issues that they might be facing. And you guys, please feel free to stop me or course correct me or what have you at any point. Happy to adjust on the fly. I guess the big picture on the legal side, lawyers, we're super important and we really think we're important, but at the end of the day, we're not creating value like you guys are. Our job is to try to protect the value that you guys are building. I mean, that's really the bottom line. And so most of what we're doing is trying to keep folks sort of in a best practice mode as much as possible, so that, as you operate your business and hire employees and take on investment and maybe someday, get sold, that you're not getting picked apart in the process is sort of the goal here, and allow you to sort of create and retain the value that you're building, which is where, the rubber is really hitting the road here. So let me see if I can share some of these screens. What I was going to cover, kind of 3 general topics. It'll be a little, sparky, but that's all right. First will be kind of an overview and probably a review for most of you of kind of the formation process and choices. I'm then going to run through sort of some basic intellectual property tips from a corporate lawyer standpoint. I think you're going to get a real good dose of heavy duty intellectual property law the day after tomorrow, but just the kind of stuff that I worry about as a business lawyer. And then maybe touch just for a couple minutes on the different types of startup financing that's out there and kind of what these terms mean and what they look like and what the deals sort of look like. So let me see if I can share my screen here. All right. Okay, can everybody see that?
Not currently.
Not currently. Boom.
Yep, we can see.
Okay, great. Okay. Appreciate your guys' patience. So, all right. So, kind of at the outset, from the legal perspective, when you're forming a business, there's really 3 issues that the lawyers are worried about. The first is liability, the second is tax, and then the third is trying to figure out what your long-term business goals are. So if we start on the liability side, when you form a company, what you're really doing is creating a new legal person in the eyes of the law. And the idea here is that this new legal person, this new corporation or limited liability company, has its own balance sheet separate and apart from your own. And the idea is that, your personal bank account, your car, your house, etc., those personal assets are separate from your business assets, such that if there's ever a problem, only the business assets are exposed, not your personal ones. This stuff is pretty easy to stay in line on, but there's really just a few basic rules here. The first is to make sure that you've actually formed the entity at the applicable Secretary of State level. And then once you form it, that you sort of follow through and keep treating it as a separate person. And the simplest things to do are make sure you open up a separate bank account in the company's name and keep it segregated from your own. This concept of adequate capitalization is something that the law requires that you sort of anticipate potential liabilities that your company may cause and have enough assets in there to basically take care of the public if there's a problem. The way that's typically handled, quite frankly, is by buying basic insurance for your company, general liability insurance, and that satisfies the capitalization requirement. Kind of the other easy point to keep in mind is as you move forward as your business, you no longer sign personally. You no longer sign as Dave Steigerwald. You sign as Sparks Wilson PC by Dave Steigerwald, director. Just so that you're not assuming those contractual liabilities at a personal level. The downside of all this stuff, obviously, is if you don't follow the rules, you're potentially exposing all your personal assets to risk. And the other, kind of the two other places, in addition to not following those basic rules where people get tripped up, is that they, fail to withhold unemployment withholdings with the feds. The federal government, basically makes that a personal liability of the owners if you don't withhold on people's, W-2. And the other place that, all of us get tripped up on with personal liability in the kind of company setting is, of course, when we expressly assume those liabilities. I don't know if any of you have yet had the joy of, signing personal guarantees for, leases and bank loans, but that stuff, tends to expose your personal balance sheet in addition to your company balance sheet. You avoid it as much as you can, but it's often an unavoidable risk of just doing business. I guess the only thing I would say, big picture, is that people often ask whether a limited liability company or a corporation is better or worse for liability purposes. The short answer is that any state-recognized entity is equally protective as long as you follow the basic rules. The things that don't protect you as a business structure is if you're a sole proprietorship, unincorporated, and or if you're a general partnership, just you and your buddy are doing business, and you don't file any paperwork with the Secretary of State. At that point, there is no liability shield, and you're exposed. So, a corporate versus an LLC from a liability standpoint, both equally valid. Next big picture topic was you're picking your entity type is, sort of tax efficiency. There's a whole laundry list, obviously, of entity types that are available to you. The three that people typically, focus on in the technology startup space is either a C Corp, an S Corp, or an LLC. Sole prop general partnership, we're going to stay away from those for liability reasons. Limited liability partnership is a pretty arcane topic that, the market really is not crazy about anymore. And a trust is really an estate planning vehicle most of the time. So from a tax standpoint and at the highest level, you're typically comparing a C corporation on one hand with a limited liability corporation or an S Corp on the other. A C corporation is a traditional corporate structure. It's what every public company, in America basically is formed as. And the downside from a tax standpoint is that corporate entity is taxable, and then the shareholders, the owners, are also taxable. So if a corporation makes $100, it's going to pay corporate level tax on that income. It distributes the profit then as a dividend to the shareholders, who then also recognize taxable income. And so when people start talking about double tax, that's really what they're talking about. Most of the time in a startup phase, most of us are not generating a ton of taxable income because we're spending every dollar we make and taking as an investment, on people, on expenses, et cetera. And all of those things are, tax deductions. So for the most part, most startup corporations are not living with this double tax because the corporate entity doesn't have any taxable income. It's spending every dollar it has for the most part. On the other hand, we have the C Corp on one side. The other hand, you have LLCs and S Corps. Those things are not taxable at the entity level. They are only taxed at the ownership level. So you have a single level of tax. All things being equal, those are much more attractive from a tax standpoint because you never run into that double tax situation. C corporations are obviously still extremely popular, and we all see them very frequently. And the reasons that we typically see them is that investors like them. They are efficient when you get to an acquisition from a tax standpoint. And in a C Corp, you have efficient ways to get stock to your employees, and you can have multiple classes of stock, i.e. common stock and preferred stock. That's possible in a C Corp. Different from that, an S corporation, you only have a single class of stock, only common stock. There's no real innate problem with that, except that, the venture capital community, the private equity community, those people typically want preferred stock. They want a second class of stock. So they sort of disqualify you from being an S corporation right out of the box. An alternative to an S corp that has a similar tax structure is the limited liability company, or LLC. I'm sure we've all heard of them. You can have common stock and preferred stock inside of an LLC. And they, obviously have become increasingly popular over time. They don't have the same endorsement from the investment community, largely because just they're not as comfortable with it. So forming an LLC can sometimes be an impediment to financing dollars. Final quick points here on this business goal stuff. Again, if your goal is to take on investment and get sold, typically your C corp is going to be your vehicle. You might choose a limited liability company structure. Most typically, we do that when we have a single owner come in and they're going to have a cash flow business, i.e. they're not trying to basically build and sell. We're probably going to recommend a limited liability company. If you get all the benefits of liability protection that you get in the corporate structure, but with a single owner LLC, you can disregard it for tax purposes, which means that you don't have to do a separate tax return. You just have a schedule on your 1040. It's a very cheap, easy way to create a liability shield around yourself and not have to deal with a bunch of corporate tax complexity. An S corporation is a similar structure, but it's usually if we have 2, 3, 4, 5, kind of founders. They don't need investment capital. They're just going to rock and roll straight forward and try to generate cash. At that point, an S corporation is a super efficient vehicle. The CPAs love S corporations because they are able to save a bunch of money on self-employment tax. If you think about it, there's 2 ways you can get money out of an entity. You can either basically pay compensation or you can pay dividends. And in an S corporation, if you pay a dividend, you can avoid self-employment tax, which is about 9% on the first 100 grand of income every year. And that's just a real efficient way to go. The C Corp still kind of, entity du jour. And it's where we find many of our startups because they are typically, out looking for financing and moving forward. All right, so I am gonna jump to a different point.
Can I ask a question while we're on this?
You
topic?
bet. Please.
All right. I'm D, by the way. I was wondering if have you worked with B Corps? I feel like it's a relatively new thing in the last decade or so, but have you worked with B Corps before? Is there any benefits to going B Corp, or can you talk to that at all?
Yeah, I formed a couple. And when you say B Corp, it's just sort of make sure we're all talking about the same thing here. We're basically talking about an entity that's going to do a set aside of a portion of its profit for charitable purposes.
Yeah, that's my understanding.
Yeah.
Or at least I just thought there was more. They had to do more explaining on like where they're like the good that they're doing or something along those lines.
It's definitely an interesting concept. At kind of the highest corporate level, it doesn't really create any, there's no difference in kind of the tax structure or the liability structure. It sort of imposes on the corporate documents and by B-Law statute, the idea that a portion of the company's revenues are going to be dedicated to a charitable purpose of one kind or another. It's sort of we have a lot of companies that, as part of their governance structure, basically decide that they're going to, spin off a portion of their revenue, for charitable purposes. But that's a sort of a flexible way to do it because you can kind of change that program from year to year with just by board of director action. Get into those B Corps, and it's a little more hardwired into your governing documents that you're going to do it. So we do have some clients who do it, but it's still pretty rare because most companies would prefer to retain the flexibility. on that going forward. So it's still a little bit exotic, but it's out there.
All right, thank you.
No worries. Okay, so why don't I bang through this real quick here on this intellectual property stuff. Again, I think you're going to get a much healthier dose of this the day after tomorrow. All right, so when we're working with technology startups, again, you know, our reminder is, look, lawyers are there to help protect your value, not build it. And really, what we've got our eye on, you know, in our typical practice is, at some point, a third party is going to be looking hard at our client from a due diligence standpoint, whether that's in an investment or an acquisition. And that's, you know, sort of kind of the worst, you know, healthcare physical you can imagine. It's like a root canal and every other test you can imagine. They basically grind through all of your corporate records and documents. And what they're looking for fundamentally is problems. And they're not doing it just because they're trying to, you know, beat you up on price or set aside a portion of the purchase price or the investment for as an insurance policy. You know, the issues they're looking for are ones that, you know, experienced investors have lived through and know that if the issues are there, there's probably an operational challenge. So the way that manifests itself, you know, is through this due diligence checklist. This is like the table of contents from one. You can see it's page 1 of 15. So you end up with 15 pages of legal questions about kind of what your company is done from a legal perspective, that turns into a giant data room that you then get just ground up on. Once you get to the actual transaction document, either whether it's an investment or an acquisition, eventually there's going to be a bunch of promises, representations, and warranties by you as the seller or by you as the company that's taken on the investment. And it's all this legal stuff, corporate status, you know, accounts receivable, you know, material agreements, and you're basically having to make a bunch of promises that there's no issues. And if there are issues, you know, what the investor or buyer does is, you know, they hammer you on price, or they basically say, we're going to set aside 10 or 20% of the investment or the acquisition into escrow, and we're going to treat it like our private insurance policy while we see whether or not the problems you've created, you know, manifest themselves and create financial liability. So that's when we start with companies, we have our eye on this end game, and most of what we're advising people then is to try to avoid creating these problems as time goes on, with, you know, kind of some basic protection. So running through here, you know, when you do a tech startup, you know, we're typically trying to remind people, you know, startup and first job, you know, not the same thing. And so most of your partners, most of your employees have worked for other companies in the past. And so you want to make sure that as they join you, that they don't have any lingering non-competes or other agreements that prevent them from working with you. And similarly, you want them to start from day one, you know, assigning the intellectual property they create to your company. At the end of the day, you know, you've created this company, and the whole goal here now is to create a separate legal person that has independent value. The only way you can get there is if the IP that's being created by your people is all getting parked inside of that business. If people are creating the IP and it's sort of, you know, not attached to the company is not creating value, it's just leaking. This point down here on this duty of loyalty, don't start until you stop. You know, every job probably we've all ever had that led to another one, there's often, you know, preparation for the next job while you're still in the first one. And that's okay. But you really just need to be careful that you're doing it after hours, not using your company computer, and really doing it on your own time so that your current employer doesn't end up, you know, with their tentacles on your new business. Write it up. You know, lawyers love contracts, no surprise. In this context, what we're driving at is, you know, your independent contractors, your employees, you want them to be signing confidentiality and invention assignment agreements. When somebody is truly a W-2 employee, the work that they do for you as the employer, according to the law, it belongs to you, the employer. That's the default rule. So the contract is more of a cleanup at that point. On the consulting side, if you have somebody as a 1099 contractor that's working for you, absent a written agreement, a work for hire agreement that we've all seen before, the default rule is that the contractor owns the IP they're creating, and you as the employer only get a license. And that's not a great place to be in. So, to the extent you can, you really want to get your contractors, under contract, and not have them just licensing their stuff to you. All right, so then this last point here, watch change from consulting to product. Many of our clients start, kind of as service business, development businesses, what have you, while they're generating enough revenue such that they can get into product development and start selling product. And that's a very typical business model, sort of pre-revenue, pre-funding. The challenge there that we all just need to keep our eye on is those service contracts that we have with customers are often related to our product development. And you just want to make sure that as you are engaging with your customers, that you're not assigning or selling your core IP as part of the services, and that you are in fact just doing, work for hire, kind of unrelated code development, because the last thing you want to do is have to get a license back from your customer for your product, as you move forward. And that line gets blurry, the closer that transition from kind of services to product happens. You just, you need to be managing that, as the entrepreneur. Patent and trade secret policy. Obviously in the technology space, if you're not an open source company, having the secret sauce is very important. You'll have to, make a decision early on. And again, Mike will talk about this on Wednesday, between trade secrets and patents. Fundamentally, a trade secret is a technology development that you truly keep secret. It's the formula for Coke. It's the secret sauce. The benefit of a trade secret is there's no filing fees or maintenance fees, and it theoretically could last forever. If you can keep it secret forever, it lasts forever. A patent is a government provided monopoly over a technology space. But in order to get that government monopoly, you have to disclose it through the patent filing, and then the clock is ticking on its expiration. So it's stronger while it exists. But the clock is ticking on it, and people are going to have access to your patent. They're going to be able to, kind of reverse engineer and patent around it. So it's just requires some careful thinking on the front end. Branding and trademarks is just, names anymore are just a nightmare is the reality. When I first started and the internet was just starting, it was a lot easier to find a true, company name and company brand. Nowadays, most good names that we all could think of have been taken by somebody, so it just gets harder and harder. What we typically recommend for clients is they check 3 places, when they're thinking of either their company name or their product names. Can you get the domain? Is the name available at the state Secretary of State website so that you can form it with that name? And then see whether or not there's any filed trademarks at uspto.gov. There's a database called TESS. And you just want to see whether or not the name you've picked has been trademarked by some big honking gorilla company that's in a similar space to you. If there's a federal trademark and the product is unrelated, it's probably still good to go. But if you see a really big company in a similar space to your own with a similar name, you should, keep researching and pick a different one. Joint ownership, I'm not going to talk a ton about that, but oftentimes our clients get approached by other startups and they want to do joint development and jointly own IP. To the extent you can, try to stay away from that, because the long-term costs of trying to manage a jointly owned IP, figure out who's going to owes who royalties, who can patent, who can't. It's just a kind of a costly, painful way to do business. outbound licensing, if you're a product licensing company, the big ticket items here are typically just, to manage your exclusivity and make sure that you don't kind of ace yourself out of markets by virtue of giving somebody an exclusive right to your stuff. Inbound licensing, I'm sure that I would guess that many of you use open source technology in your own development. We certainly have many, many clients that do so. It comes up in pretty much every significant customer relationship that our clients have, as well as every financing and every acquisition. Those parties want to know what open source software you've got embedded, and whether there's any risk to them. The issues with open source, I'm sure we're all familiar with, but fundamentally, some open source licenses require a disclosure of source code and or free distribution. Neither of those are good things for the development company, generally speaking, and customers, investors, and buyers don't want it either. So it's really the lesson there is just, as you incorporate open source software, you want to take a look at their licensing terms and make sure that the worst thing they have there is a copyright notice requirement, and that they don't have this sort of mandatory source code disclosure and or mandatory royalty-free disclosure provision. We can avoid that for today. Again, the goal here at the back end of this thing is to try to, to the extent you can, own the intellectual property that you and your people are creating, and avoid contracts that kind of undercut that. Just a few kind of random points here, as part of the startup process. Mistakes that we see, our clients make from time to time. Usually startups start pretty informally, and that's just fine. And you don't need lawyers end to end here. But to the extent you're getting together with some of your colleagues or friends and starting to put a deal together, try to write it down, even if you just do it in actual English without a lawyer early on, to avoid misconceptions and misperceptions about who owns what relative to each other. You'd be surprised, even just one-page memo between the two of you, that it's 50-50 and not 70-30, or people just make mistakes. Once you start a business and you're actually starting to create product and or contact customers, just please make sure that you've taken the step of forming the company with the Secretary of State, articles of incorporation, articles of organization. You certainly don't need a lawyer for that, but it's well worth the step for you guys to take that and get that done early on. To the extent you can, and again, largely from a cost management perspective, create a set of sample terms and conditions, a standard license agreement, a standard SaaS agreement, whatever your business model is, such that you can present that to customers and or have that available for download or click wrap. Try to make that sales process as easy as you can while still protecting your intellectual property. This securities law stuff is a headache, but the bottom line, securities laws are complicated, but they really boil down to two things. When you sell ownership in your company to a third party, Dave Steigerwald is going to be an investor in your business. There's really two things to pay attention to. One, if you're taking somebody's money as an owner, you have to disclose material facts to them about your business. And that's a little bit of a squishy concept, but the idea there is that you tell the investor anything that would really be a go, no-go point about your company. And practically speaking, what that means is you have to be able to provide them with a cap table that shows who owns what. You need to be able to provide them with a balance sheet that shows, what are the assets, what are the liabilities. You need to be able to show them kind of the baseline corporate documents, articles, bylaws, that kind of stuff. And then tell them whether or not you've got any, threaten regulatory or litigation coming against the company. Tell them what you're going to use their money for. It's all anti-fraud, and as long as you're upfront with your investor, generally speaking, you're not going to trip up the securities laws. The other, part two of the securities law piece is that you don't want to do a public offering until you really want to do a public offering. An IPO, we all hear about that, concept. There's not a lot of IPOs going on in the world. The only way you get tripped up on that in our little world that we all deal with is if you go out and try to raise money over the internet and you basically start to publish advertisements for your stock sale. At that point, you sort of cross over from permitted private sales of securities to prohibited public offerings of securities. We had a deal about 10 years ago. Some of the local business newspapers in town, who are very supportive of the startup community, which is awesome, but they created a page on the back of their weekly newspaper that was an offer sheet. It had term sheets for private companies in town that were raising money, and they published it, to a couple 100,000 people. I think there were 8 companies listed. 5 of them were our clients, and it basically took this permitted private offering and turned it into a prohibited public offering. And it was just a disaster. We had to shut the whole thing down and restart everybody, and it was really tough. So all the way I'm coming around is if and when you raise money, raise it in a private method from friends and family or from business people that you've been introduced to, and avoid sending an email out to your entire inbox about how you're looking for money. Some of the stuff we already talked about. This right advisor thing, that sounds like it's a plug for lawyers, but I guess if I could say anything on hiring service professionals to help your business, the most important person is a CPA, because that person is who you're going to talk to, every month, every quarter, every year about how to manage your tax situation. Your lawyer, hopefully you're not talking to that frequently. So lawyers are great, but hiring a CPA early on can really save you a lot of heartache and a lot of money. So whatever you can do to sort of help on that process is great. All right, so I know I just ran through a whole bunch of stuff. I was going to cover one more thing, but any kind of questions here in the interim?
Hey, Dave, this is Kevin and Steve with Echo. One, thank you so much for doing this. This is actually really great information. I definitely don't want to derail you if you have other points to make.
No, it's all good.
Okay, awesome. Just so a couple specific questions. So Steve and I, we've been operating under an LLC essentially, just to make sure that we had a good balance sheet process for capturing our revenue, et cetera. But incorporating for a C Corp is, hopefully we're looking at raising funds in hopefully the near future. Delaware C Corps, as we understand it, are pretty popular, even if you're living out of state or physically operating out of state. Do you have any opinions or insight on Delaware C Corps versus incorporating a C Corp here in Colorado?
Yeah, no worries. Yeah, good question. So I would say, I guess a couple things. Like 10, 15 years ago, everybody formed their corporations in Delaware, and because Delaware historically had the friendliest corporate laws. And so investors and companies knew that, and they flocked to Delaware, and it was really just a financial revenue generator for the state of Delaware. They knew it, and they just kept making the laws friendlier and friendlier. Over time, as you would guess, the other states all picked up on that, and so they had what was called a race to the bottom, which basically all the states, copied Delaware's corporate laws. And so now, 95% of the states have laws that look identical to Delaware's from a corporate standpoint. So substantively, there's no longer much difference, if any. Now, all that said, you had 50 or 100 years of Delaware momentum, to be the kind of the leader. And so the professional investment community, still prefers Delaware, all things being equal. It just feels comfortable to them. You know what I mean? They know the code sections, and the courts are very, mature. And so Delaware is still preferred. The only downside for you guys in the startup phase is, if you're not headquartered in Delaware, which most people are not, you form in Delaware, and then you got to qualify to do business in whatever state you have employees at. So it's a little more expensive, annually. You might spend an extra $1,000 a year for the pleasure of being a Delaware corp. On the other hand, if you're able to raise 10 or hundreds of thousands of dollars, it's worth it. So, if you're thinking that you're only going to need to raise money from friends and family, I would go Colorado. If you're going to go out and try to raise money from VCs and PEGs, I'd probably go Delaware.
Okay, no, that makes perfect sense, and thank you for simplifying that for us.
Nope.
Just one last follow-up. The actual, the technical function of exchanging shares. So let's just say that, we went with the Colorado C Corp because, we've got some friends and family that are potentially interested in investing.
Yep.
Okay, so we've gone through the incorporation process. We've done our due diligence, articles of incorporation, organization, et cetera, et cetera. What is the technical function of actually exchanging shares to those friends and family?
You bet. So, you form the C Corp, the founders own 100% of the outstanding stock, right? That cap table is, you two guys, and there's, two numbers, and then there's 100%. That's the current snapshot. So then you go out and raise money, and you're basically going to sell off, some portion, of the company stock. The company will be the issuer of those shares because you want the money to land in the company's bank account, not, your guys' bank account. So you guys continue to hold your stock. The company issues new shares. You guys get diluted. Let's say you sell off a third of, the company, what have you. The mechanics of that basically are either a subscription agreement or a stock purchase agreement. That's what your investors are going to sign and what you're going to sign with them. You're going to attach to either of those documents some of those things I rattled off earlier, like your balance sheet, your cap table, your articles, your bylaws. You're going to give them all the basics so that you cover yourself on that anti-fraud stuff. You know what I mean? You take their money and they become a shareholder. I'm not, certainly Colorado and Delaware, neither of those states require you to issue an actual stock certificate. Shares don't need to be certificated anymore. It's just a matter of who's on the company's records as being an owner. Some investors still like to get a stock certificate, but technically you don't need to do it. It's all done by contract anymore. And so it's a relatively simple process. As you're raising, startup money, the only two things I'd keep in mind is, make sure you keep that private money raising mentality, right? Don't do the mass email. And then, while you're raising the money, the magic number to keep in your head is if it's over $2 million in total, proceeds, the disclosure and compliance obligations get a whole lot harder, is the bottom line. So if you're doing a friends and family round, you generally want to stay below $2 million. And to the extent possible, you would like all of your investors to be accredited. And that's a SEC term that basically means that they either have net worth of $1 million or they make more than 200 grand a year. If you raise more than 2 million, that's mandatory, fundamentally. If you're below 2 million, it's not mandatory, but it's sure nice because you get the court system treats those type of people as wealthy and able to protect themselves. And so if they ever got their nose bent out of shape and they're accredited, most courts are going to be like, caveat emptor. Whereas if it's grandma, and she doesn't have any money and she doesn't make any money and you take her money and then you lose, the courts are going to be sympathetic. So, 2 million and below is a good place to be. Accredited, if at all possible, is a good place to be.
Got it. Okay, no, that makes perfect sense. And the last one, I promise this will be the last one.
No, it's all good.
Okay, so definitely picking up on your recommendation for trademarks, brands, et cetera, to get that started early.
Yeah.
Looking at doing those searches. If you think that, again, we are pre-seed, pre-revenue, and so we're at concept, we've done some prototype testing. When do you recommend getting aggressive with actually trying to get a patent submitted as well? I mean, is it the same advice in terms of the trademark searches and things like that, and then actually if you think that you have some space there with the USPTO?
Yeah.
To start working and start getting some actually registered IP?
Yeah. No, that's a great question. So our general advice to people is, certainly when you pick your name and pick your brand, do that research, from the get-go, and try to stay away from names where you can't get the domain, or you can just see the big gorilla that's in a competitive space with a similar name. Because if that's the case, go a different direction. We typically tell startup clients, cash is king, money is dear. Don't go for a federal trademark or a federal patent, right away. On the name side, do your best to pick a name that looks good and reserve the domain, file with the Secretary of State, but hold off on a federal trademark because that's typically a $2,000 expense. And you really just, it's that's near and dear money in the startup phase. I typically, once you're actually ready to go to market, and you're gonna, start either alpha, beta, or God forbid, even customers. At that point, if you've got a trademark budget available to you, and you've actually come up with a name that looks like it's a strong brand, an Apple or an Exxon, some of these names that don't mean anything other than in connection with the product. I mean, that you want a fanciful name that has no connection. Those are the perfect names. If you're lucky enough to come up with one of those, I would go for the federal trademark at the time you're going to market with your product. On the patent side, patents are obviously even, way more expensive than trademarks, right? I mean, you're talking 25, 35 grand without blinking an eye. So once again, we recommend generally that, our startups don't start there unless they're really heavily financed from the get-go, and that they try to keep everything as a trade secret initially. Keep it confidential, make everybody sign NDAs, and then if it, you can then start doing your patent research. And is this technology something that's going to have a relatively short life, but we really need a monopoly? At that point, maybe I go for a patent. On the other hand, if I think this is like a forever technology and I don't really want to publish it and have it expire in 20 years, I'm probably going to try to keep it a trade secret. So, big picture, hold off on the trademark and patent as long as you can, just because it's, money out the door, bottom line.
Awesome, Dave. Thank you so much.
Hey, no worries, man.
Dave, we've got a couple of questions for you from Fetch. Jose from Fetch. Jose, do you mind unmuting yourself and saying these questions out loud, or would you prefer?
Sure, no problem. Yeah, I can go. Hi, Dave. How are you?
I'm good. How are you?
Doing well. Just a couple of questions. You answered one of them with the accredited investor. But, we have a mobile app, and there's a lot of privacy language, not to mention the practices of the whole securing data. Any recommendations as to when we need to start looking at that language, and how often does that change? I haven't seen it change too often, but again, what would be a best practice for that? Is that a every quarter type of thing? Just make sure that the language we're using when people sign up for the app, or change, we have to change privacy statements, things of that nature. How often should we take a look at the language, and how complicated really is that? I mean, it sounds like it's been a bit of an issue over the last, year, 2 years.
Yeah, you're right. It's, the privacy rules are painfully complicated, and it seems like they get more complicated every month. With the Europe's GDPR and California's adoption of their privacy rules, which are likely going to spread everywhere. It's harder and harder. Most of our software clients are reviewing their privacy policies typically with every new release is kind of the way they've been doing it. You know, that's probably not the greatest discipline. I love your idea of reviewing it every quarter. If you can kind of institute that as a company policy, that would be tremendous. But practically speaking, most of our clients, when they go from, 12.0 to 12.1, that's when they're looking at it. Or when they're doing a major release from 12 to 13, that's when they're looking at it. It's kind of a complicated topic, but really what it gets down to is, are you capturing, PII, personally identifiable information, of people that are in one of these wonderful jurisdictions like Europe or California? Because if that's the case, then you gotta jump through all the hoops, which net at the end of the day is largely one of express consent to the collection and utilization of their PII. But there's a zillion ways they can trip you up on it. So I love the idea of quarterly reviews. That'd be awesome. At a minimum, do it every time you have an updated release or version. And then be conscious of, if you're an internet-based, app or, what have you, that people can download it from anywhere, you should probably assume that you're going to have California and or Europe users, and you're going to have to comply with the GDPR and the CCA. And, many of our startup clients, would prefer not to pay us to do all that brain damage, which I totally get. I wouldn't either if I were on their end. And so they're stealing, privacy policies from folks, from some of the bigger companies, HubSpot, you pick it. You can get most of the way there. As you kind of ramp into revenue, it's probably worth paying a lawyer at that point.
All right. Okay. That makes sense. Yeah, I usually try to go with the most onerous one and apply it.
Sadly, that's right.
How I'm covered. And the second question real quick was, we have NDAs out there. I'm sure you guys deal with this, obviously, since you're a law firm. From a small perspective, is there any software out there, tools that can help us manage the contracts that we put out there, even if they're NDAs, so we know when they expire, what our responsibilities are, et cetera? That's really hard to do.
You're basically saying a contract management tool. I'm not aware of any that I could recommend. Most of our clients end up creating kind of a proprietary system, where they have ticklers, on contract start, contract end, renewals. So I don't have a software tool recommendation, to be honest with you. The fact that you're worried about it is fantastic. At least early on, I would probably do it, if it were me, by Excel, to be honest with you, but that's not a very elegant or slick tool. There may be tools out there, but I'd have to look just like you.
All right. Just checking. Thanks.
Yeah, no worries.
Any more questions for Dave before he moves on to his last document? All quiet, go ahead.
All right, let's see here. So, all right, so I thought I'd just run through real quick. This may or may not be of interest to everybody, but just to kind of get people more familiar with some of this lingo that's out there when people start raising money, which so many of us are in the startup space. So that, the types of investors that people talk about, just to give you a little bit of flavor here, friends and family is usually the first thing that happens. And those people are just who they sound like. They're friends and family. They're typically buying common stock, not preferred stock. So they're going to own the same kind of stock as you typically. They're not looking for control, which is helpful. There's usually not a lot of bells and whistles. It's usually very early in the business, and they get diluted heavily. So that's the main thing to communicate to those folks typically on the front end, if you want to stay friends and family with them, is that, yeah, it's awesome to get in on a successful startup, but when you are the first money in, you're almost for sure not the last money in, and you're going to experience some fairly significant dilution going forward. An angel is basically professional friends and family. It's usually a individual, non-institutional investor. It's usually kind of the Series A round. When people talk about that, that's oftentimes an angel investor round. Those people are also going to get heavy diluted. But they're, it's very helpful money. They usually have a little bit more resources than your friends and family. And there's those angel networks that are out there all over the place. And if you can tap into them, they're a good source of funds. VCs then are venture capitalists. That's the classic professional investor. They're for sure going to buy preferred stock from you. They're going to look for a minimum 20% stake in your company. Ideally, you're holding them below 50% in your company, and you're trying to maintain control as best you can. We all hear the stories about how nasty and mean VCs are. Some of that is earned, but much of it is not. They're in it to make money. And the way they make money is by making your company successful. So that, their interests really are pretty aligned with the founders. Where those things start to separate is when a VC believes or recognizes, at least in their own opinion, that the entrepreneurs can no longer keep up with the company. The company's outgrown the entrepreneurs. That's when, these hard VC stories start, because then the VCs start replacing management with, kind of professional, development stage company management. And that can be hard for a founder. So it's just something to be aware of, that once you get sort of in bed with those professional investors, you're along for the ride. A private equity is sort of a different flavor of a VC. What they are typically doing is they're not investing 20 to 40%. They're trying to buy 80 to 90% of your company and leave you in as a 10 to 20% owner. They want to own all the upside, and they're typically willing to pay a premium for that. So it's a nice way for you as an entrepreneur to exit partially early on. You're going to cap your return because you're going to sell out at a lower valuation. But private equity people, they rarely lose money. So if you take their investment, you can assume they're going to flip you to another peg and keep stacking it. So it's not a bad way to go. It's just one of those deals where you're sort of saying to yourself, you know what, I'm not going to keep going for 10 years. I'm going to exit at year 3. And I'll take a 30% return as opposed to a 3,000% return that I might be able to get if I hung in the whole time. Mezzanine financing, that's typically not an equity deal. It's a secured debt deal. So it's sort of a fancy bank deal, for lack of a better term. They're much more risk tolerant than a Wells Fargo or a Citibank. So you can, they'll invest in an early stage company, a mezzanine lender. They usually charge quite a high interest rate, as you would suspect, and they typically want to get warrants or options in connection with their debt. Again, it's just another financing vehicle that can make sense at different points. A strategic investor is just what it sounds like, which is basically, it's either going to be typically a traditional customer or supplier of your company, and they decide that you're going to be their horse and they're going to ride you and pump a bunch of money into you. It usually means that you're going to be a successful company, but again, it's sort of like the PEG model where you're limiting your options. Because if you take money from a particular strategic investor, most of their competitors are no longer going to be interested in you. So you've either severely limited a portion of your supply chain, or a potential diverse customer base. On the other hand, that strategic investor is probably either going to supply you cheaply or buy a boatload of your product. So it's probably going to guarantee you some level of success. It's once again just going to sort of ceiling it by limiting some of the rest of the market, because everybody's going to know that you're a Oracle company or you're a Apple company or you're a Uber company or whatever, and their competitors are not going to want to play ball with you. Institutional, that's just that last point. That's basically traditional bank financing. most of you guys, I know I'm about done, but just real quick, everybody wants to talk about convertible notes and safe vehicles. Both of those, a convertible note is basically the right, it's a loan that converts to equity later. It's usually done at a point where you raise a fixed amount of money. It converts into that equity at a 20 to 30% discount. Convertible notes are nice because they are simple. They have defined terms, and you can force that debt into equity once you raise whatever the threshold is, $2 million, $3 million, whatever. It's something that where the company maintains control. A simple agreement for equity is all the rage. Target company lawyers like myself generally don't like SAFE. And the reasons are that it also is an agreement to invest, and it is going to convert to equity at some point. It's different from a convertible note in the sense that the investor typically controls when it's going to convert from a SAFE into actual stock. And it's typically not converting at a discount from the third-party price. It's converting at a fixed valuation, which is usually quite low. And so what happens with these SAFE vehicles is they basically lie in the weeds for years and years. And then when the company is worth 20 million bucks, the SAFE investor pokes his head out of the hole and says, yeah, I'm going to convert my SAFE instrument now at my negotiated rate 5 years ago of $400,000. And it really can blow up your cap table. So that may be more negative than it should have been, but if I could coach you on these early stage investments, I would strongly urge you to consider convertible notes, not SAFE vehicles. All right, Prakar, I think I'm out.
Awesome. Thank you so much, Dave. Really appreciate you speaking and responsible for supporting and sponsoring this. Yeah, have a good day, everyone, and I'll see you at 1 p.m. for our office hours. Thank you again.
Thanks, everybody.